Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, January 16th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, did consensus get too bearish too soon? Our answers are, judging by the response to recent earnings releases and corporate guidance, yes. Stocks and bonds are right to celebrate yesterday's confirming evidence of the ongoing disinflation process in the US. While we have our data-driven doubts regarding its sustainability, we do not believe our sticky inflation theme will become consensus until late Q2 or early Q3. We know a thing or two about our research themes becoming consensus, having watched the resilient US economy theme we authored in the summer of 2022 and our J1 to soft landing theme we authored in the fall of 2023 become consensus en route to two back-to-back 20+% annual gains in the S&P 500. If you can't tell by now, we've adopted a far less sanguine fundamental outlook for 2025. The distribution of probable economic outcomes is wide and widening due to some potentially dramatic changes to U.S. fiscal, regulatory, trade, and net financing policy, all of which may perpetuate a further hawkish shift in monetary policy. That amount of change in and of itself should make you nervous as an investor after two back-to-back 20+% annual gains in the S&P 500. Timing the eventual unwind of crowded long-term bullish positioning is not something we will use fundamental research to do, and nor should you. Investors should trust that our systematic risk management overlays will do a far better job of timing that eventual pivot more than any mere mortal can, including myself. And for those who may be unfamiliar, our systematic risk management overlays are KISS portfolio construction process. We use that to help retail investors retire on time and comfortably, and our discretionary risk management overlay, which we use to help institutional investors make tons of money for their clients and make fat bonuses for themselves. So transitioning to our 42 macro dashboard here, as always, we'll wrap up with our question from our community. This one's regarding our global macro risk matrix, which is the quantitative signaling tool that we use to nowcast the market regime, which investors must position for to avoid FOMO or FOMO. FOMO is fear of missing out, and FOMO is fear of more losses. And these are the two worst things you can do to your portfolio, specifically when you have FOMO at the top of a market cycle, or if you have FOMO at the bottom of a market cycle, because it causes you to buy the cycle top or sell the cycle low. And I can't think of anything worse to do to your portfolio as an investor. So going back to the question, says, I would like to hear the story of how you invented the global macro risk matrix someday. It's by far the most complex macro analyst tool I have seen to date. Is there an old video in the video archives? So I don't know if there's an old video, but the inspiration behind global macro risk matrix, and I have to give a shout out to our friend Jim Leitner over at Falcon Management, another Yaley. He has this system that was written about in Inside the House of Money. That's a book written by Stephen Drobny. It was a bunch of interviews with global macro hedge fund managers that sort of kind of detailed their process, some of their best and worst trades. And it was really instrumental early in my career in terms of helping me kind of get up to speed on some of these more complicated, esoteric global macro dynamics. Among many others. I mean, obviously I've read dozens and dozens of finance books throughout my career. But in terms of and I know Jim. I consider Jim to be a friend now, obviously. So giving Jim the appropriate credit, he has this system that's similar to the global macro risk matrix that alerts him for significant changes in momentum across a large variety of assets, not just in the U.S. but all around the world, and it helps him identify trades, typically faster than kind of his fundamental research process as it identified trades, and that's really helped him generate some really superior risk-adjusted returns throughout the lifetime of this global macro hedge fund. So that's something that I got inspiration for in terms of building the global macro matrix, which is trying to figure out, okay, when is the market shifting from pricing in one dynamic to another dynamic, regime A to regime B? Are we risk on or are we risk off? Are we risk on with a disinflationary bias, i.e. Goldilocks? Are we risk on with an inflationary bias, i.e. reflation? Or we risk off with a disinflationary bias, i.e. deflation? Or we risk off with an inflationary bias, i.e. inflation? That's what our global macro risk matrix system is designed to identify, is exactly are we or are we not risk on or risk off? And if we are risk on or risk off, is the market pricing in a inflationary or disinflationary impulse? And that if you can get those things correct, you can get your asset allocation and your portfolio construction vis-a-vis factor long short bets correct. And that's the name of the game and institutional finance. And obviously you can use that kind of information, and we are using that same level, that level of institutional insight to guide our, more, less sophisticated, proper, asset allocation tools as well, specifically our KISS portfolio construction process. So we'll wrap it up there. Darius Dell presenting our macro minute for Thursday, January 16th, 2025. Hopefully everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.